Hello and welcome to Crypto Weeklies. In this video, we analyze S&P 500 and its ticker SPY. None of the content is financial advice. Although this is a ETF based on top 500 companies, they are stock-based assets. Although it's not crypto, but again, crypto does get impacted by what S&P 500 is doing. That's why we analyze it today. Now that the crypto market is currently in the downturn, you can check that on the home page of the website CryptoWeeklies. If you go under indicators, right now the heat map of the top cryptos, again barring a few names, most of the assets are down over the last 24 hours, over the last 7 days, 30 days and 90 days. So in this downturn, it behooves to analyze the other assets, which makes the wider market move based on what they are doing. S&P 500, again we have the for machine learning price forecast and the regression based valuation for that. Right now the price of the ticker is at around $680. It's closer to the range highs. It rarely, again from 1993, if you see over here, it rarely spends a handful number of days below this blue line, which is the days to weeks, which is the 50-week simple moving average. Before we do any more technical analysis, one key area to look for from the 2021-2022 highs that S&P had, the bottom in 2025, again 4 years later, was essentially slightly higher than the 2022 top. So usually that kind of structure with lows, even the lows are for S&P for every 4 years are higher than the highs of the last 4 years peak. So what was a peak in 2021 became a bottom in 2025. In this kind of patterns, again you can see over here as well. In 2020, what was the peak? In 2020, the 2022 drop was higher than the 2020-2021 peak, and so on and so forth. Even over here, from the 2015 peak, the 2020 drop and even the 2019 drop or late 2018 drop was higher than the previous peak. So whatever ends up happening in 2026, one key level to look for is what happened in 2025. If that's the top or guidance for any downturn in 2026, if any, that level for S&P is at around $600 and $610. So going back to the website and looking at first DCA opportunity or any dollar cost averaging opportunity based on what's the regression based fair value. One level to look for is whenever the prices are below the 50-week simple moving average or close enough to the 50-week simple moving average. That's when historically speaking, good deals or good dip buying opportunities for S&P holders who do dynamic dollar cost average kind of emerge. The DCA model over here right now takes into consideration the polynomial or non-linearity between what non-linearity in terms of what is the fair value of S&P at any given time. Although this model is more geared towards identifying the peaks than bottom, it does help in identification of risk levels where the S&P accumulation risk has gone down significantly. So for now, again, if you see the risk, if and when the risk is less than 30%, or in this regimen of ignoring the other risk levels, based on this regression based line, in October, November 2025, there were a couple of days when the risk, again these are rounded off, was at around 0.33. Before that, the April May drop, the risk levels were essentially in that level. Even in March 2020 drop in that blue region, and also in 2023 October scare, the price did come close to that regression based undervaluation territory. So this is, again, this model is right now the non-linear model. We'll also soon launch a linear version of this model, which takes into consideration the linear regression based fair value. Right now, focusing on the non-linearity as the price of S&P, if the market cycle were to conclude in 2025 or early 2026, price is closer to the peak than the bottom. So that's why, again, if there are any peak related estimates for S&P at this point, if you were to again extrapolate with some caveats next 3 to 6 months into the future, if there is a parabolic bull run for S&P from now till let's say April 2026, the ceiling for S&P is somewhere between the current price and $900. So that's the fair value. If there is one push from the current valuation to the fair value for S&P, which is currently estimated in this bullish euphoria phase at around $791, roughly speaking $100 higher than the current price of S&P. If we were to be more conservative and identify what's the bottom or bottoming chance using this again data since 1993 for S&P, in the next without any significant bearish phase in early half of 2026, the support levels for S&P is between $637 and about $670. And again, this again correlates beautifully with this ascending 50-week simple moving average. If let's say the ascension continues and let's say the price meets that 50-week simple moving average in February to March of 2026, they could meet at somewhere around $630. That's the non-panic scenario for 2026 for S&P. If there is a panic case, the 2 standard deviation bear case or the 95 percentile dark green line, that's where the $550 to $560 could be the bottom for S&P. And then again, depending on when it occurs, again from week to week, if it occurs in February, it's at around $600. If the bottom occurs in May, it's at around $550. So $550 S&P would be slightly below the prior peaks of 2025. So that would be the ROI for 2026 would be negative. That is not too uncommon. But again, the major peaks again usually when they are occurring, the major bottoms after the next major bottom, they are usually higher. The bottoms are slightly higher than the previous peak. So that also remains to be seen if this is the latest peak of importance, or maybe if the one prior to that, the one that which was set in 2024 or even in 2023, if that could come into play again. In 2024, the S&P did go to all-time high at around $550. So that could be one area of support again. This support did not matter as much in the 2025 bottom, but hopefully that level matters in the 2026 downturn, if there is a downturn. On the other hand, if there is a bullish case for 2026, the first half, that is, the bullish ceiling is at around $822. That's where the regression based valuation also was extrapolating. Again, this model uses seasonal ARMA and LSTM based machine learning based forecast and confidence levels based on standard deviation. This is a non-euphoria bull run ceiling for S&P in the next 6 months. If there is a significant euphoria again for S&P, such assets again, they're not as volatile to go to the 2 standard deviation peak for more than 2 to 3 months again. So that comes up with a caveat. Let's say in mid-March, if there is a euphoria between now and mid-March, the ceiling for S&P is at around $850. Anything above that, again, we need further evidence to check for any more euphoria. So the range for S&P, if there is no euphoria or panic, is between for the next 6 months is between, again, the lower end is between $630 and the higher end at around $825. That's the weekly average forecasted by the machine learning model. The key elements of the DCA strategy, again as we move towards the linear model, before we move away from the non-linear model, is what's the current risk of accumulation for S&P. Again, it's relatively low because it's geared towards identification of tops at around 0.36. Nonetheless, it's not as low as it was back in March 2020 or even in April 2025, those, and also in October 2023. So personally speaking, again, not financial advice, if I were to use these kind of models, again, the cutoff point, if we don't have a panic between now and the next 6 months, anytime the price of S&P has a regression risk less than 0.3, or in this blue region, that's when again I pay more and more attention. Right now that's not the case. So that's the conclusion for S&P valuation. With that, I would like to conclude. Hope you enjoyed the content. If you did, please give a like and subscribe, and hope to see you again tomorrow. Thank you and have a nice day. Bye bye.